Let's move to the last term in the free cash flow formula, the change in net operating working capital. Looking at the balance sheet, there are three items for us to forecast: accounts receivables and inventories on the operating current asset side, and accounts payables on the operating current liability side. Let's start with accounts receivable. As you can see from the balance sheet, for the last 3 years, accounts receivables has been increasing over time. This should not be a surprise. The firm sells more every year, and hence it is natural that accounts receivable, that is the amount customers owe the firm, also increases. As we've done before, it seems that we should normalize accounts receivables by sales. While there is nothing wrong in using a financial ratio such as accounts receivables over sales, here I will use accounts receivables over daily sales instead. The reason I use daily sales is that the financial ratio I will obtain has a very natural interpretation. It is the average collection period measured in days. This is the definition. I refer to this ratio as accounts receivable days on hand, but it's also called days of sales outstanding. Typically, this ratio is computed using only credit sales, but I will use total sales as I do not have a breakdown between credit sales and cash sales. Let's see the historical information for accounts receivable days on hand. As you can see, accounts receivable days on hand starts at 29 days in 2015 and increases to 36 days by 2017. This ratio is not constant, and so simply taking an average might not be such a good idea. Something is going on, and we should understand what it is before trying to estimate accounts receivable for 2018. Imagine you are able to call Manoa's CEO, and you ask her about their accounts receivables. The way you estimate accounts receivables in 2018 will depend on her answer as to why accounts receivable days on hand has been increasing. I will give you two different potential answers that will lead to different assumptions for 2018. First, imagine that the CEO tells you that they have had some problems with their collection department. A key employee left, and they have been struggling to get a new person for this position. As a result, they have been less efficient in collecting from customers. However, Manoa has recently found someone great for the position, and they expect to return to accounts receivable days on hand of about 30. In this case, you should use 30 as your estimate of accounts receivable days on hand for 2018. Second, imagine the CEO tells you that there is more competition in the market. While the new competitors are not decreasing price, they are all giving customers 45 days to pay. In the past, Manoa has been giving customers 30 days, but in the last 2 years, they have been forced to give some customers 45 days. As competition intensifies, the CEO believes they will change their policy and give 45 days across the board. In this scenario, it will make more sense to estimate accounts receivable days on hand for 2018 at 45. I will assume the second scenario and hence will forecast accounts receivable days on hand at 45. Let's now solve for accounts receivables. Recall the definition of accounts receivable days on hand. We know accounts receivable days on hand for 2018, and we also know sales in 2018. Therefore, we can solve for accounts receivables. I want to make an important point here. Many people use mechanical formulas to project free cash flows. For example, some people always use averages of historical ratios no matter what. As I hope you can see from these discussions, although there are some cases when averaging ratios make sense, there are other cases when it will lead to incorrect estimates.